The phenomenal wealth achieved by William Delbert Gann was not the result of chance or guesswork, but the strict, unwavering application of a deterministic system that treated market movements as mathematically predictable phenomena. Gann, operating in the early 20th century, claimed to have unlocked the universal laws governing price and time, believing that every fluctuation was governed by fixed, cyclic rules. This premise was famously tested and validated during the 1909 Ticker and Investment Digest interview, where he executed 286 trades, achieving 264 winners, and demonstrating returns that proved his millionaire status beyond doubt. His wealth was fundamentally built upon 5 non-negotiable rules that fused stringent financial discipline with a highly sophisticated, often esoteric, application of time and price mathematics. Before we delve into the core mathematics that underpinned his fortune, we must address the foundation of any successful long-term trading career. Please take a quick moment right now to subscribe to the channel and leave a comment below, even if it is just a single word. This simple action significantly boosts the algorithmic visibility of this video, ensuring this valuable historical analysis reaches more dedicated traders like yourself. Furthermore, remember that this channel serves as a resource to return to during those inevitable challenging periods when market volatility tests your confidence and trading discipline begins to waver. Now, let us begin the deep dive into the mandatory rules Gann established for generating enduring market wealth. William Gann's primary directive, the foundation upon which all subsequent analysis rested, was the absolute preservation of capital. He understood that complex forecasting methods were meaningless if a trader failed to survive long enough to capture the predicted cyclic moves. Therefore, Gann mandated the strictest financial discipline. Never risk more than 10% of total trading capital on any single market or position. This 10% rule was not merely a suggestion. It was the mechanism that guaranteed longevity in the inherently volatile environment of speculation. The enforcement of this critical 10% limit necessitates the immediate mandatory use of protective stop-loss orders upon entering any trade. A trader must calculate the difference between the entry price and the stop-loss price to ensure that the potential loss, should the trade fail immediately, never exceeds the defined 10% threshold of the total portfolio value. This disciplined approach removes the possibility of catastrophic losses that wipe out the entire trading account in a single, unforeseen market shock. The protective stop-loss transforms speculative risk into a known, quantifiable business expense, making the overall trading operation scalable and predictable. Gann recognized that even a highly skilled analyst relying on advanced mathematical models would inevitably experience losing streaks. The power of the 10% rule is revealed through simple arithmetic probability and the law of large numbers. Even if a trader achieves a 50% win rate, meaning half their trades result in a loss, they can still achieve massive profitability if the losses are strictly capped. By ensuring that winning trades inherently yield more profit than the strictly defined 10% loss limit, the system guarantees long-term accumulation. This rule is the ultimate defense against the emotional impulse to hold on to losing positions, which Gann identified as the primary downfall of amateur traders. The fixed stop-loss prevents the psychological trap of hope, which often convinces traders to let small losses balloon into account-destroying events. Survival in the market is the prerequisite for wealth, and the 10% rule is the non-negotiable insurance policy against premature extinction. It ensures the trader remains liquid and ready to execute the next high-probability setup identified through the advanced rules of time and price analysis. The mathematics of capital preservation must always override the immediate desire for massive, risky profits. The concept extends beyond just the initial 10% risk. It also governs the overall exposure to any related asset class. A sophisticated trader must ensure that correlated markets do not collectively expose more than the critical risk threshold. For example, if a trader is long in crude oil, they must carefully consider their exposure to other energy sector equities or related commodities. This holistic view of risk management prevents a single systemic shock from crippling the entire trading operation, maintaining the integrity of the total capital base. Gann understood that the goal was not to make money quickly, but to make money consistently over decades, capturing the major cyclic movements of the economy. The 10% rule ensures that even if 10 trades in a row fail, the trader still retains enough capital to analyze and capitalize on the 11th, potentially life-changing opportunity. This strict constraint forces the trader to be highly selective, only taking trades where the projected reward significantly outweighs the tightly managed risk. It is the gatekeeper of all subsequent successful speculation, demanding patience and mathematical rigor above all else. The practical application requires constant vigilance and recalculation as the capital base fluctuates. As the account grows, the 10% limit naturally increases, allowing for larger position sizing in absolute terms, but the percentage remains fixed. Conversely, during periods of drawdown, the position size must be aggressively reduced to respect the lower capital base, preventing a downward spiral of increasing risk tolerance. This dynamic management of exposure is what separates the disciplined market operator from the reckless speculator. The adherence to this master rule of preservation is the foundation of turning trading into a verifiable science rather than a gambling endeavor. Without this financial discipline, the advanced tools of time and price forecasting that Gann developed become merely interesting theories, incapable of generating lasting wealth. The trader must internalize the fact that market survival is the ultimate metric of success, allowing the compounded returns to build gradually over time. This foundational rule is the necessary prerequisite for understanding the next level of Gann's methodology, the prediction of market timing. Gann's second non-negotiable rule stemmed from his belief in the law of vibration, asserting that market movements are not random but are governed by fixed mathematical relationships and natural cycles. He postulated that every price movement is merely a manifestation of specific energetic frequencies, which can be charted and predicted through precise time measurements. This rule requires the trader to forecast the exact moment in the future when a price reversal is most likely to occur based on the historical rhythm of the market instrument. The ultimate goal is to identify points where time and price meet in mathematical harmony. The specific method employed here is known as squaring price and time, which is the cornerstone of Gann's esoteric forecasting techniques. This technique requires finding points where a specific price movement, measured in points or dollars, takes the exact same number of time units, measured in days, weeks, or months. For instance, if a commodity moves 30 points from a major low, the trader must look for a major turning point exactly 30 days, weeks, or months later as the market is deemed to have completed a square. This mathematical convergence signals a high probability reversal window. The application of this technique allows for the identification of major turning points based on fundamental cyclic units derived from the circle and natural geometry. Gann heavily relied on the 90-day, 180-day, and 360-day cycles, which represent the quarter, half, and full rotation of a circle. These cycles are considered sacred timing units, reflecting the natural rhythms of the Earth and the cosmos, which Gann believed were intrinsically linked to human psychology and market speculation. When price action aligns with the completion of one of these major time cycles, the conviction for a reversal trade becomes extremely high. For the purpose of wealth generation, this rule allows the disciplined trader to identify major market extremes, the exact highs and lows, with remarkable precision. By forecasting a 360-day cycle completion that aligns with a significant price level, the trader can initiate large leverage positions with confidence, knowing the foundational mathematics supports the directional bias. Unlike reactive technical analysis, this method is fundamentally proactive, demanding that the trader know the market's future turning points before they arrive. The 360-degree cycle, representing the full year or the full rotation of the circle, is considered the most powerful timing unit for predicting major, multi-year market reversals. Gann's deep commitment to this rule required more than simple calculation. It demanded a profound philosophical acceptance that the markets followed a deterministic path. He taught that time is the most important factor in market analysis, often stating that when time is up, the market will change direction, regardless of the apparent trend momentum. This focus on time allows the trader to avoid the trap of trend chasing, instead positioning themselves strategically ahead of the inevitable cyclic shift. The market is viewed as a meticulously wound clock, where every major oscillation is predictable based on its prior period. The technique of squaring price and time is applied across multiple time frames simultaneously to increase the confidence level of the prediction. If the daily chart suggests a reversal at 90 units, and the weekly chart suggests a reversal at 180 units, and these time periods align closely in the calendar, the resulting trade setup is given maximal weight. This multidimensional approach to timing ensures that the trader is not relying on a single isolated indicator, but on the convergence of fundamental cyclic relationships. Such confluence provides the necessary conviction to deploy significant capital under the constraints of the 10% rule. The law of vibration also emphasizes the importance of smaller harmonic vibrations within the larger cycles. For example, a 360-day cycle will often see minor corrections or pivots at the 90, 180, and 270-day marks. A skilled Gann trader uses these smaller cycles to manage existing positions, perhaps taking partial profits or tightening stops, while maintaining the core position based on the forecast of the major 360-day reversal. The market is thus seen as a symphony of interlocking cycles, all operating under the same mathematical rules. The commitment required for Rule 2 is immense, demanding meticulous charting and calculation, often involving astronomical and geometric principles, which Gann believed governed all natural motion. However, the reward for this dedication is the ability to forecast market movements years in advance, giving the trader an unparalleled strategic advantage. This predictive power, coupled with the strict financial discipline of Rule 1, forms the essential framework for generating millionaire-level returns through strategic market speculation. The precision offered by cyclic timing dramatically reduces the guesswork inherent in conventional trading methods. Rule 3 introduces the crucial element of geometric analysis, utilizing specific angles drawn from significant market highs and lows to confirm and measure the stability of a trend. Gann's geometric angles are essentially lines that define support and resistance based on a fixed ratio of price movement per unit of time. These angles measure the rate of change and provide clear visual markers for trend health and potential reversal points. They act as dynamic support and resistance levels, adjusting constantly as time progresses. The critical importance rests on the 1-by-1 angle, which is geometrically represented by the 45-degree line. This specific angle represents the ideal equilibrium between price and time, meaning that for every single unit of time that passes, e.g., 1 day, the price moves exactly 1 unit, e.g., $1 or point. This 45-degree angle signifies a perfectly healthy, stable, and sustainable trend, where the market is advancing at a steady, reliable pace without becoming overheated or collapsing prematurely. It is the benchmark for measuring market strength. The actionable rule derived from this geometric analysis is straightforward. A market trending distinctly above the 45-degree angle is strong and should be held or added to. When the price action remains consistently above the 1-by-1 line drawn from the last major low, the trend is confirmed as robust, justifying the maintenance of long positions. Conversely, if the market price falls and closes below the 45-degree angle, it signals a definitive break in equilibrium, indicating either a reversal or significant weakness that demands immediate protective action, such as exiting the position. The application of the 45-degree angle is vital for achieving millionaire status because it addresses the common trading flaw of exiting profitable positions prematurely. By using the 1-by-1 angle as a dynamic trailing stop, Gann's traders were instructed to stay in major trend moves for extended periods, maximizing the accumulation of profit until the trend mathematically proved it was unsustainable. As long as the market maintains its ideal rate of ascent, the position should be held, allowing small profits to compound into massive gains. This rule enforces patience during periods of high profitability. Gann's system utilized a full fan of angles, such as the 2x1, moving 2 units of price per 1 unit of time, and the 1x2, moving 1 unit of price per 2 units of time. While all angles provide support and resistance, the 45-degree angle is the most critical because it dictates the underlying stability. If the market breaks the 1x1 angle, it usually signals a shift to the slower 1x2 or 1x4 angle, indicating a loss of momentum and a potential consolidation phase. If the market accelerates to the 2x1 angle, it suggests an overbought condition that may be unsustainable in the long term. The geometric angles are not static lines. They are dynamic representations of the market's inherent energy flow. A trader must meticulously redraw the angles from every significant pivot point, high or low, to maintain an accurate map of the current trend trajectory. This constant charting ensures that the trader is always reacting to the market's current mathematical reality, rather than relying on outdated or arbitrary support levels. The intersection of these geometric angles often coincides precisely with the time cycles identified in Rule 2, creating powerful confirmation setups. Rule 3 demands visual clarity and objective measurement of trend health, removing the subjective element of feeling whether a trend is strong or weak. If the price is above 45 degrees, the trader is mathematically obligated to remain long. If it is below, the obligation is to exit or reverse the position. This rigid visual confirmation system eliminates the emotional second-guessing that typically erodes trading profits. The visual evidence provided by the angles enforces the necessary discipline to ride major trends to their logical geometric conclusion. The long-term wealth generated by this rule comes from its ability to capture the majority of a trend's movement, allowing the compounding effect to fully maximize returns. A trader who consistently respects the 45-degree angle will inevitably hold positions longer than the average speculator, thereby capturing the necessary magnitude of movement required for true financial independence. It serves as the visual confirmation that the market is respecting the underlying mathematical structure that Gann believed governed all speculation. William Gann's fourth commandment was a strict prohibition against overtrading, and an absolute mandate to wait patiently for the perfect setup. He understood that the greatest enemy of the speculator is boredom, which leads to impulsive trading based on insufficient data or emotional reactions. Trading merely for the sake of trading was forbidden. Instead, a position could only be initiated when the market provided ironclad confirmation based on the convergence of at least 3 distinct analytical methods. The convergence rule is the practical mechanism that enforces the waiting game. Before taking a high-conviction trade, the setup must be confirmed by the alignment of 3 independent factors: the geometric angle, the specific time cycle, and a crucial support or resistance level, like a major historical high or a 50% retracement. If the time cycle indicates a reversal, but the price is still holding above the 45-degree angle, the trader must wait for the geometric confirmation before acting. This triple confirmation filter drastically reduces the number of trades taken, but exponentially increases the probability of success for those that are executed. This rule demands immense patience, often requiring the trader to sit idle for weeks or even months while waiting for the market to perfectly align its mathematical components. Gann taught that the majority of profits are made in a very small percentage of trading time. The rest of the time is spent observing and preparing. The discipline to wait for the market to confirm the analysis based on repetitive historical data patterns is the hallmark of the professional speculator. Impatience is relegated to the realm of the amateur. The payoff for this disciplined waiting is the strategic use of pyramiding, the method of adding to winning positions, but only when the market confirms its continued strength. Pyramiding is executed strategically, moving up to the next geometric angle or confirming the next minor time cycle. Crucially, as the trader adds to the position, the initial stop-loss discipline, Rule 1, must be maintained or even tightened on the entire aggregate position. This exponential scaling of profits is the engine of Gann's massive returns, but it is only permissible in setups validated by the triple confirmation rule. Pyramiding is inherently dangerous if executed recklessly, but under the guidance of Rule 4, it becomes a controlled mechanism for leveraging success. Each new addition to the position must be supported by fresh confirmation, ensuring that the market is continuously validating the initial thesis. For example, if the market breaks the 1-by-1 angle and moves strongly toward the 2-by-1 angle, that movement provides the confirmation necessary to pyramid. If the market merely stagnates or consolidates, no additional positions are taken. The psychological benefit of the waiting game is that it forces the trader to view the market objectively, removing the desire for immediate gratification. When a trade is finally taken, it is done with high conviction because the confluence of three independent mathematical systems supports the move. This high conviction allows the trader to weather minor adverse fluctuations without prematurely abandoning the position, differentiating a confirmed move from market noise. The trader knows the math is sound. Gann's historical success was largely attributable to his ability to remain detached and wait for the precise moment when the stars aligned mathematically. He recognized that the majority of speculative losses come from trades taken out of compulsion, not conviction. By instituting the triple confirmation rule, he provided an objective, non-negotiable barrier against emotional trading. The market must prove itself worthy of the trader's capital before any risk is deployed. This disciplined approach ensures that capital is only risked on high-probability, high-magnitude moves. While the amateur trader chases every rumor and small fluctuation, the Gann practitioner waits for the major cyclic shifts confirmed by geometric stability and historical data. This strategic selectivity is what transforms incremental gains into the exponential returns necessary to achieve millionaire status. The waiting game is not passive. It is the most active form of strategic preparation. The final foundational rule that tied Gann's entire system together was the absolute requirement of historical data mastery. Gann maintained that the future is merely a repetition of the past, and therefore accurate forecasting relies entirely on the meticulous study of historical market behavior. This rule demanded that traders maintain a comprehensive, lifelong record of market activity, known as the master chart. The master chart was not a simple line graph. It was a highly detailed document recording every significant market move, including precise volume data, time components, and the exact geometric angles drawn from all major pivots. This meticulous record-keeping was necessary to find the repetitive patterns or vibrations that would inevitably manifest again in the future. Without this historical database, the calculation of future time cycles and geometric intersections, Rules 2 and 3, would be impossible. One of the most crucial calculations derived from this historical data mastery is the identification of the mean or halfway point. This refers to the exact 50% retracement level of any major swing, from a significant high to a significant low, or vice versa. Gann considered the 50% retracement level to be the most critical pivot point for future trend reversals and consolidations. If a market rallies back to the 50% level of its prior decline, it is at a high risk point for resuming the original downtrend or confirming a complete reversal. The wealth generation proof of this rule lies in the ability to use the historical data to calculate the precise intersection of all three major analytical components. The trader utilizes the master chart to determine the exact price point where the time cycle, Rule 2, and the geometric angle, Rule 3, would intersect based on past performance at that same 50% level. This convergence provides the highest possible conviction for a trade, allowing for the deployment of maximum permissible capital under the 10% risk constraint. Gann's famous cotton prediction, where he accurately forecast the price of cotton months in advance, was the direct result of applying this historical mastery. He identified the repetitive time and price cycles that had governed cotton for decades, allowing him to pinpoint the exact date and price of the future turning point. This was not magic. It was the result of exhaustive historical research and the application of highly complex yet objective mathematical laws. The historical data provides the map to the market's future movements. The requirement of historical mastery extends beyond mere price levels. It includes understanding the psychological impact of specific time periods. Gann charted how human sentiment shifted at the 90-day, 180-day, and 360-day marks, recognizing that the collective psychology of speculators repeats in predictable cycles. By studying how the market reacted to the 50% retracement level historically, the trader can anticipate the psychological reaction when that level is tested again in the present. The market is a mirror reflecting past human behavior. This rule emphasizes that trading success is a research endeavor, not a speculative gamble. The trader must dedicate significant time to charting, calculating, and analyzing historical movements before ever risking capital on a live trade. The master chart becomes the trader's most valuable intellectual asset, representing decades of market history compressed into an actionable forecasting tool. The depth of this historical knowledge provides the confidence needed to execute high-stakes trades when the mathematical conditions are met. The long-term millionaire success of Gann was predicated on his unshakable belief that price movements were not random walks, but predictable orbits governed by fixed laws. Historical data mastery provides the necessary calibration for those laws, ensuring that the forecasts are grounded in verifiable, repetitive market behavior. Without this meticulous record-keeping and analysis, the advanced rules of time and geometry are rendered useless, lacking the necessary empirical foundation. William Gann did not become a trading millionaire by selectively applying one or two of his rules. His extraordinary success required the simultaneous, disciplined execution of all 5 rules as a single, cohesive system. The foundation of the system is the absolute preservation of capital, Rule 1, which ensures market survival. This financial discipline provides the runway necessary to apply the advanced forecasting techniques. The predictive power is derived from the law of vibration and cyclic timing, Rule 2, which forecasts the exact time windows for reversals based on mathematical ratios. This time forecast is then visually confirmed and monitored by the stability indicator, Rule 3, the 45-degree angle, which dictates when a position should be held or exited. This entire analytical structure is only actionable when the trader exercises the immense patience of trading only on confirmation, Rule 4, waiting for the convergence of at least 3 factors before deploying capital. Crucially, all these rules are grounded in the empirical foundation of historical data mastery, Rule 5, ensuring that every forecast and every angle is calibrated against the verifiable, repetitive patterns of the past. When these 5 rules are used together, trading transcends mere speculation and becomes a verifiable mathematical science where risk is tightly controlled and high-probability outcomes are strategically pursued. The complexity of the system is offset by the certainty of the prediction it provides. This comprehensive approach demanded a level of commitment and intellectual rigor far beyond that required by conventional trading strategies. Gann proved that market success is not about having the best indicators, but about having the most disciplined, holistic, and mathematically sound approach to time and price. The rules are non-negotiable and must be applied universally across all markets and time frames. Understanding the depth of Gann's commitment to historical analysis illuminates the resources required to master his techniques. For those dedicated to delving deeper into the foundational thinking of this trading legend, we highly recommend exploring William Gann's classic work, Truth of the Stock Tape. This book offers invaluable insights into market cycles, the psychology of speculation, and the necessity of rigorous financial discipline, echoing the principles we have discussed today. While the text provides unparalleled access to Gann's philosophy and market worldview, it is important to note a practical limitation. The original historical charts included in the book are often of very low quality due to the age of the document and reproduction limitations, making them difficult to read for direct analysis. Nevertheless, the theoretical framework and psychological insights remain profoundly valuable, offering the necessary mindset required for success. If you are serious about understanding the intellectual origins of modern market analysis and the mindset of a true trading millionaire, you must study this classic text. Find the link to Truth of the Stock Tape in the description below, and commit to mastering the historical perspective that underpins all successful speculation.